Hey everyone, good morning. In the interest of staying on time, I'd like to launch the session. So welcome to the session number 11 this morning on financial development. We have three interesting papers. The first paper is by Amanda Gregg, who will be here in person in Tucson, and Caroline Fohlin on financing industrialization in Germany and Russia. So take it away.
All right, let me adapt the microphone for my height here, if I can. Can everybody hear me okay? Thanks everybody for being here in person and virtually. So yes, as Kris said, this is joint work with my lovely co-author, Caroline Fohlin, who is in the Zoom room available as well. So we begin this project with a large and ambitious question. We're trying to understand how industrialization gets started, especially in late industrializing contexts. We want to understand the key determinants of firm finance in such late industrializing countries. And there exist several answers to these questions, but a lot of those answers are based on research that's conducted either at the cross-country level or that examine specific single country cases at the level of firm or corporation microdata. What we endeavor to do in this paper is to provide a close corporation level comparison of two famous and canonical cases of late industrialization, Germany and Russia, in the period around the turn of the 20th century. This comparison, as this audience will know, is especially interesting because these were two key cases considered by Alexander Gerschenkron in his portrait of late industrialization. What we argue in this paper using newly stitched together microdata is that German and Russian corporations use broadly similar and actually flexible financial strategies, but there are a few key differences. In particular, there are just far fewer Russian corporations, and they're quite selected because of the Russian concession system of incorporation. And also, Russian leverage works a little differently. Russian leverage was actually negatively related to fixed assets because of the way the Russian debt market worked. I'm going to emphasize to start three key differences between Russia and Germany in terms of their levels of economic performance in this period and also their institutional differences. So first, broadly, we cannot forget that in this period, Russia and Germany were poor countries. Compared to, for example, Great Britain, both Russia and Germany are just at a much lower level of GDP per capita. However, Russia was much poorer than Germany, and this is important to keep in mind when thinking about how the corporations will develop. But furthermore, if you take a look inside of the assets of those countries, so Russia is at a smaller level, but even at that smaller level, as a share of total assets, financial assets are much smaller in Russia compared to Germany. Germany had a much more developed financial system. Furthermore, there are important institutional differences in the regulation of corporations and financial markets. Most importantly, in the Russian Empire, there was no system of general incorporation. So rather than simply having to meet some standard bar and turning in standard forms to become a corporation, any firm that wished to incorporate had to obtain special permission from the imperial government. And I've argued in some other work that this concession system was time-consuming and expensive for corporations to navigate and resulted in important distortions in industry. Furthermore, a peculiarity of corporations in Russia is that even though the Russian commercial code says that all corporations are the same, they're all the same thing, there are actually two types of corporations that self-identify. They say that they are either A corporations or share partnerships. And we can use this distinction as actually a proxy for being widely held or closely held. And this is going to be important in this paper because those A corporations are going to look more like the German AGs. In Germany, furthermore, they had general incorporation since 1870s. That's a major difference in how corporations are selected. The German corporations are all Aktiengesellschaften, so that's more like the Russian A corporations. And German firms had a wider menu of options, which also will impact how firms choose to incorporate or not. In Germany, firms since 1892 had the option to form as a private limited liability form called the GmbH, while Russian firms did not have this option. They could choose to be single proprietorships, partnerships, or corporations. And you can see the impact of all of these factors together just in terms of new incorporations and the patterns of new incorporations in these two countries. So you can see immediately, first of all, that there are just a lot more German AGs than there were Russian corporations. And there were even fewer Russian A corporations, so the kind that are more like the German AGs. What's actually kind of interesting is there are a few periods where the incorporation rates actually move together for these two countries. But there are, you can see some moments where there are a lot of German corporations being formed, but very few are being formed in Russia. Also, you can see how this relates to the overall sizes of the countries. So there are, a lot of people in Russia. It was a gigantic country. In 1910, there were about 403 corporations per million people in Germany, but only 10 per million people in the Russian Empire. So given these major differences, we have a short set of hypotheses for how corporations should appear different at the micro level. So what we expect to see, and we've already seen this, is just far fewer joint stock corporations in Russia than in Germany. We also will see less developed stock markets in Russia than in Germany, and that will have an impact on how those corporations are using stock markets. Thus, we expect a greater reliance on debt finance for Russian corporations than for German corporations. And all of this matters because firms that aren't able to choose their ideal mix of capital may not be able to achieve economies of scale. And so we'll also be able to see briefly in this paper that capital access, it has a relationship with profitability and survival. And we hope to explore that in greater detail in future work. All right, so now let me show you pictures of cool old data and explain the data task that's at the center of this paper. So first, we have this incredibly detailed data set of German Aktiengesellschaften. This is a random sample of about 300 plus joint stock industrial firms, which are matched forward and backwards in time to form a panel. This data, which Caroline originally collected, it has incredible detail. It tells you everything you would want to know about performance and the balance sheet, bank interlock, stock markets, a very detailed portrait of debt finance and management and much more. And you can see the original detail in this source, which is just incredible. And we bless Caroline for her effort to standardize this into usable data. The original sources for Russia are similar. They are slightly less detailed. So, for example, we don't know bank interlocks, which is kind of a shame because I think that would be interesting. But Stephen Apster and I have collected the entire universe of joint stock industrial firms every year from 1900 to 1914, based on financial reports made regularly in financial newspapers. And so this is a complete portrait of the balance sheets with expenditures, dividends, all sorts of things, plus some additional information from an existing database made by Thomas Owen with all information on these corporations at the moment of their founding. And what's actually even lovelier in the Russian case was that very kindly, the Ministry of Finance collected this all together and did a lot of the work of standardization and made these into these beautiful tables that we could just simply collect and then match over time in a regularized way. The task of this paper then is to take these two data sources, which are relatively similar, and stitch them together to make a single master database of corporations in both countries with, a dummy variable for whether the corporation is located in Russia or Germany, and other balance sheet items and performance related items that are in an apples to apples comparison standard so that we can make corporation level comparisons. And so once we completed that standardization, we can immediately start to take just a bird's eye view of the data set and of corporations in both of these countries. And so first, notice there are far fewer corporations in the data set for Germany than there are for Russia. That's just because of the choice of sampling versus the universe. But also notice that when we convert the revenue of corporations in Germany or Russia to rubles, and so I did this part, which is why it's rubles, you can see that the Russian corporations are so much more selected. They are huge. They're much larger than the German corporations that are less selected. And that's even more true if you look only at the Russian A corporations. And also that's true if you look at par share capital in rubles as well. The German corporations are larger. The Russian corporations, or I'm sorry, the German corporations are a little older, but not by much. And also the German corporations, as a first difference, they're much more likely to be listed in Berlin than Russian corporations were to be listed in St. Petersburg. So this is already a first indication of how German corporations will be much more likely to be using stock markets. And you can also see this difference in size visually. So you can see that there's far fewer Russian corporations, but when they are founded, their average share capital is greater than the German corporations. This just shows you some idea of our effort to stitch together the data sets by reconstituting their industrial classifications and trying to create a system of industrial classification that represents the variation for corporations in both countries while not being too fine and not being too broad to lose the detail. And here you can see some really interesting similarities and differences. So, for both countries, metals and machinery, mining and fuels represent important sectors for corporations. A few interesting differences. Actually, there's a lot of alcohol production in both countries, and it really is beer in Germany and vodka in Russia. That's actually true. But the share is much larger for the German corporations. And also, Russian corporations are quite concentrated in cotton production, mostly for domestic consumption. And also, there are a lot more Russian corporations producing foods for domestic consumption, which again may be just further evidence of the different levels of overall development in the two countries. So what I'm going to be able to focus on in this presentation today are tests that we use in the paper to create contrasts in capital structure. And so just to recall, we expect major contrasts for these cases. First, given Russia's lower level of development and the existence of free incorporation in Germany and a booming business and IPO underwriting, we expect German corporations will be more likely to use stock markets. The Russian corporations will more likely rely on debt and profits. And so what I'm going to show you are overall means and some multivariate analyses, particularly random effects regressions of leverage. And so here's just sort of a first punchline of the paper. Look at these debt equity ratios in Russia. They are quite massive. And Russian capitalization ratio is much smaller compared to the German case, which has a much smaller debt equity ratio. And when you restrict your analysis only to the Russian A corporations, the differences are a little bit less, but the basic pattern remains that Russian corporations or A corporations are more reliant on debt than capitalization to finance operations and expansion. And you can see that as well in the overall distribution. So, our effort to try to put these two data sets into one standardized basis was really to run regressions of this type, where we can think about leverage as the log of debt equity and regress that on just the Russia-Germany dummy, but also a set of standard controls, including industry controls, year controls, and so on. And also complete some further robustness checks to put these data sets on the same basis. And what you see overall is that indeed, Russian corporations are using a lot more debt, even if you control for industry and if you control for other standardized elements in a regression like this, like return on assets and fixed and the ratio of fixed to total assets. When you think about running these regressions separately, what's really cool is that broadly they're using similar financial strategies with one key difference, which is that the German corporations have what you would expect as a positive relationship between fixed assets and leverage, like using fixed assets to get better debt finance. But the Russian corporations have a negative relationship because the Russian corporations just aren't doing that. So I will just wrap up here with my final 30 seconds to minute and give you some sense of where the paper is going. So what we're trying to do in this paper is to provide a detailed a micro-level comparison of Alexander Gerschenkron's two core cases of relative backwardness. And what we find is that for these two cases, which in several respects have similar institutional backgrounds, for example, similar legal origin, they have moderate differences in industrial development. What we see is that what really bites is differences in financial development, but also differences in how they restrict the formation of incorporation, which is ultimately tied to the political differences between these two countries and how they think about entry. So in future versions of this paper, we're going to keep doing some more robustness on how Russian corporations report profit values, restricting our attention to Russian A corporations, and thinking more carefully about listing rates. So thank you so much. I look forward to hearing Matt's comments and everyone else's comments.
So for comments, we have Matt Jaremski.
Can everyone see this online? I might have to stop the share of that thing and start this one. How about now? Everyone online, we good?
Yep.
All right, so I really appreciate the opportunity to discuss this paper. It's always just fun to read papers that are not necessarily purely in my area of expertise. So very quickly, I'll caveat everything with this, is that I know very little about Russia or Germany at this time. So a lot of my comments are going to be focused kind of from a little bit more of an outsider perspective. But this is great because these are phenomenal data sets from two of the preeminent scholars on these two things. Amanda did a great job really summarizing the paper. I would have loved to have seen a lot of those visualizations in the paper itself. So let me just really quickly, hopefully get this going. The paper, just quick summary, it's examining the structure of German and Russian firms around the turn of the century. Okay, random sample about 300 German industrial firms, and then basically the entire universe of Russian incorporation during these two time periods, very similar time periods. Most of the paper, the way it's written right now, is a focus on leverage composition. That's where the most of the efforts put into place. There are some summary statistics on other characteristics, things like that. So going back through, we'll talk a little bit about that. Main conclusions is that firms in both countries have substantial levels of equity financing, which is kind of different than you would expect given the Gerschenkron literature, talking about backwardness paradigm. Countries that had similar legal origins, but different than ultimate outcomes of how you're structuring, how you're carrying out those activities. Okay, Russian firms, again, generally had higher leverage ratios across their cross-section rather than German. Authors argue the difference is related to Russia's strict incorporation controls. So let me pause here and just say, there's a ton about this study that you really have to like. And I think they've done an incredible job of not only collecting the data, but then making sure that it is merged correctly so that it matches to. There's always things that I could talk about to nitpick little things, but I don't think anything, and I really spent a lot of time with industrial labels as well as how you're putting things in. I think there's little changes you could make, but in the end, I think it's never going to make a difference. So I really believe that there is this difference between Russia and Germany. So I would strongly encourage everyone to kind of go read it because there's a bunch of stuff buried in there. But in the end, I'm going to have two small sets of comments and then kind of the bigger picture. So the first is the smaller comment. I want to start with this because it's very much about the paper the way it is written right now. So there needs to be a lot more additional context, okay, for outside readers, but also just for people that are thinking about this, okay? These two authors are preeminent scholars in Germany and Russia. But I kind of was left thinking about this, whether these two countries, if you had the universe to pick from, are these the two countries you would pick? Are these the two countries that would give you the analysis that you really want to be? The big question that Amanda led off, but also the paper keeps hitting again, is does industrialization get funded? But you're picking countries that are the two of the stranger ones. And so what I kept thinking back through is I'd like to have seen just more discussion from the authors on why, if you were picking two, you'd pick these. Okay, Gerschenkron talks about it. They are backwards, but the countries are at different points in their growth curves. They have already established laws and regulations. So you're seeing them kind of relatively late in things that they might be changing. Different income distributions, different wealth distributions. I mean, even from kind of taking a step back, I was trying to think of what that ratio would be. What is a benchmark? If we're comparing, so if we're just like the US or even England or something like this, Japan, something that's a little bit more traditional, what would be expecting? So I don't know if going back and attributing Gerschenkron's idea that it would be all bank debt on a balance sheet. I don't know if that's necessarily the correct view, but is that number, 40%, 50%, 60%? I'm not sure. And I'm just hadn't done enough in the literature to really do that. I would love to see you two kind of come up with that and just kind of think of, as we step back, this is kind of what we're thinking benchmarks would be. There's a footnote in there that cites, I think, 5 different developed countries, but I didn't know what time periods they were. I'd like to see a little bit more of that. Also, the authors have used some of this data before, so it'd be just helpful to know, because I think in some of Caroline's work, there might have been this ratio that's come out, hasn't been analyzed, but just kind of talking a little bit about it for those who aren't done. I'm just going to quibble for a second because I think that I'm always expected to do this. I'd love to see a deeper analysis of the other variables, like the profits, the returns, the numbers, the size, all these other interesting characteristics that really factor into industrialization during this time period, even fixed assets over total assets. That's a really interesting outcome that's kind of put as a control and given in a summary statistics table. I'd love to see a deeper analysis of those, of the same way you address the kind of leverage effects. I'm going to strongly suggest you use the same years for both samples, because it's great to have more data, but you're getting into World War I. You're getting into a lot of different things with Germany versus others. I think it's really easy to kind of cut those off. I'd love to see a match sample by firm, age, and industry. I think essentially what I was thinking is you just take those 300 German firms and match them to their nearest neighbor in Russia to see this. I think that would be a really strong way to do it. And last but not least, and Steve's in the room, so he can tell me differently too, is that I'm not seeing the value of a panel analysis that it doesn't include fixed effect or doesn't look at the time dimension. It's essentially just a lot of repeated observations of the same firms again and again. Some new ones, some are leaving, but it's just, I'm kind of thinking through the econometrics on that, whether we're just artificially inflating and deflating the standard errors to lead to significant effects. Just really quickly things that could be mentioned. Okay, so let me get on to the bigger one in my last few minutes. Okay, conceptually, I want to push the authors to do this bigger paper. Like Amanda kind of said, I'm really interested in this bigger idea of what leads to industrialization. This paper isn't quite there yet. This paper is looking at a particular aspect I think is very interesting, but I want to see the bigger study. I want to see the paper that's going to lead everything else going forward. I want to see Gerschenkron's next book in you guys, essentially, right? So I'm just pulling out quotes from the abstract and the conclusion, right? Just kind of go here. Tight entry restrictions fundamentally distorted patterns of corporate finance and governance in Russia. We highlight the role of corporate law and regulation in promoting informational transparency, safeguarding investors, and promoting market-based industrial finance. I want to see that paper. I want to see the paper that goes in and says, hey, we actually want to look at, and we can get at the specific aspects of this regulation in the longer run. Some of that you've done before, some of that Caroline's done before. I want to see it in this paper. Okay, I essentially want to encourage you guys to go focus on the mechanism, because right now the paper summarizes each country's legislation, does a great job of kind of talking about the various differences. I think the presentation did it even better, if I had to be honest. But in the end, it's a cross-sectional analysis that says, okay, everything that's associated with Russia versus everything that's associated with Germany. I'd love to see that unpacked a little bit. And I know it's hard, but it'd be great to be able to get at some of those specific regulations. I don't like the idea of just constantly having to reference previous works, in that you just have to believe those previous works are the true kind of basis. I'd like to see that incorporated here. I don't know if you can do, if there's changes in regulations in place. I know there's taxation changes that you could get at, a few other things, but I'd even love just to see the differences. Firms created before big changes versus after. Even if you observe them 30 years later, there still should be a kind of a structural imprint on those. So this is what I want. I would love to see this paper turned into a much longer, a much more detailed paper where we use these comparisons. Speaking for my own interest, I'd love to see a supply side versus demand side effect, right? Is this that regulations affecting the banking side, right? Germany has universal banking. Russia has kind of scattered banking a little bit more. So is it affecting that bank side of things, or is it affecting the firm side? And I think that involves a little bit more. You said you have financial firms. You could go at some of those. I'd love to see that, because that is what's going to take the literature to the next step, essentially, rather than just kind of saying, hey, this is different than what we've said before, versus, hey, let's do something, astounding with this. So with that, I will leave it to questions. But I really enjoyed the paper. I incredibly suggest people to go in and do it.
Okay, that's great. We have about 4 minutes for questions. I see a hand up in the Zoom room, and one or two in the audience. So we'll give Chenzi the first question, and then people in the room can come up.
Oh, awesome. Thanks, Kris. Super cool paper. Since we don't have much time, I just wanted to ask whether we should understand this paper as maybe a comment on Modigliani-Miller. So it seems like what you're saying is that there is a difference between equity financing versus debt financing. And so should we think of this as, hey, look, they do things very differently, and actually outcomes are very similar. They both industrialize. It leads to a lot of growth for these countries, and so maybe it doesn't matter so much. Or whether, hey, there's something about these two institutional contexts that breaks Modigliani-Miller, and so we can dig into that and sort of make a comment about when it is that debt versus equity is preferable. That's all. You're muted.
Is Amanda going to answer?
Oh, so I'm just asking about the institutional environment. So the bankruptcy environment, taxes, for example, kind of the standard things that we think about when we teach trade-off theory and corporate finance. Just knowing the extent to which that was similar across the countries, that seems like really important context for understanding the capital structure choice.
One more question from Matthew Suandi.
Yeah, thanks, Amanda and Caroline, for the paper. So my question has to do with the national origin of the equity financing. I'm not sure if you can observe that, but I'd be very interested to know if the similar levels of equity financing between Russia and Germany are concentrated in those industrial sectors where the French government specifically made large investments to prop up the war industry in Russia, because the fundamental issue here was that France was 40 million and Germany was 65, I think, in 1913. So that's my question. Thanks.
We have like 90 seconds or a little bit more if Amanda wants to come up and have a quick response. Or
I'll just say I don't know a few times. No. So first here, I'll demask. So first, let me just say, Matt, thank you so much for what a lovely comment. That includes both things that we can absolutely do and improve this paper, and also homework for 10 to 20 years, leading to several more papers and potentially a book. Caroline, I hope you're ready for that. So thank you so much. I think that there's a few things that we do in the paper to try to apples to apples these data sets, especially based on the timing, like reconstituting a sample in Russia based, using the same method for Germany. I don't think I did ever actually literally do like the same years, but that's very simple to do. So thank you for giving us suggestions that are really quite easily implementable, and I think are going to really improve the paper. Chenji, is this a comment on Modigliani-Miller? I think we quite blatantly tried not to go there, but I'm happy to try. So I think that there's a deep question there, right? Which is, when you see these differences, do we think of the reason that, for example, Russia's ratio is different because it's facing some kind of fundamental inefficiency or distortion that potentially is going to make those corporations perform worse? That's a really difficult counterfactual to investigate, but perhaps we can make a gesture in that direction. So I really like that question. To Sasha, I don't have a quick answer to you right now on bankruptcy because bankruptcy in Russia is pretty difficult to understand. But we do have some detail in the paper about taxation. And my current understanding is that Russian corporations faced higher corporate taxes on their incomes, which is a difference in perhaps how they account for profits, which is another reason to think about robustness checks for the profits column. And then to Matthew's comment on the national origins of equity, I really wish that we could know exactly where all the money is coming from in the Russian case. But you make an interesting suggestion, which is perhaps there's some proxy by sector that might be interesting to investigate. So that's a really interesting suggestion. Thank you guys so much for your deep questions.
Thanks to everyone for good paper. And next we'll turn to Chenzi Xu, who will be presenting on monetizing the economy. So you can go ahead and share. We're up and running. We can see here.
Yeah.
Go ahead.
All good? Okay, awesome. Thanks a lot for putting me on the program, and thanks, Mark, for discussing the paper. So this is joint work with a classmate from grad school. This is actually her job market paper, and we had a lot of fun writing this. So curious to hear everyone's thoughts. All right, so the broad motivation is tied to two strands of literature. The first is this observation that economic activity doesn't exist in autarky, and improvements to physical infrastructure that have reduced physical trade costs have led to better market integration and economic outcomes. And this is true both in emerging markets today as well as in the US at different points historically. But related to these physical trade costs is the fact that non-physical trade costs actually compose a large part of overall barriers to trade. And so this comes out in, for instance, Anderson van Winkoop's really seminal work in this area. So related to that, in prior work, I've looked at the ways in which financial markets can directly intervene and help to overcome these non-physical trade costs through a direct financing channel where they're improving the supply of capital. But also we can think that there are additional indirect channels. And in particular, the indirect channel that we want to emphasize in this paper is that financial intermediaries can be a source of liquidity creation. And this goes back to an old idea from Wharton Panacci, which just highlights the fact that anything that we use as money in the economy has these liquidity and safety features. And the issuers of these liabilities can actually back these liabilities in a way that makes them very safe and therefore useful as a transactions medium, right? So they show that banks are particularly well positioned to issue riskless liabilities, and as a transactions medium, we can think of this as lowering trade costs associated with payments. And so overall, in economy that has better access to payments and monetary services is going to have higher market access because they can interact with and trade with more economies at a lower cost. All right. So in this paper, we're using the National Banking Act of 1864 as a historical laboratory to ask whether bank-created liquidity, in addition to direct credit, is going to impact trade-related local economic activity. And there are classic empirical challenges with these sorts of questions. The first is the very standard one, which is that financial markets aren't randomly allocated across space. So usually they go to places where they expect to grow and to do well. In addition, non-credit channels are pretty difficult to observe. So these, liquidity measures aren't balance sheet items, so we can't just see what these banks are doing there. So in order to overcome these challenges, we leverage the institutional context of the National Banking Act, where in particular, the exogenous variation for financial markets these banks moving into different places come from regulatory capital requirements based on town populations. And this is very closely tied to work that Mark has done. And so it's been really nice that they've laid out this instrument, and so we don't have to fight that battle. And in terms of figuring out these non-credit channels, we use the specific institutional details differences between national banks and the types of banks that existed beforehand to back out what the likely impact of these banks would be. So, broadly speaking, this was legislation that was passed to create better capitalized banks. So there's really a view toward promoting financial stability. And these banks would have a new uniform currency and specialize in non-agricultural and shorter-term credit. So for each of these three bullet points, I'm going to discuss the particulars of the institutional detail, and then we'll transition into the empirical results. All right, so the capitalization is going to be the source of identification, while this introduction of a uniform currency is going to be this indirect channel that we want to look at, which is essentially this liability side related changes to bank services. While the non-agricultural emphasis is where we're going to try to make an argument, that, we can shut down the direct channel in some sectors and allow the direct channel to operate in other sectors. And that's related to asset side changes, so direct loans that these banks would be making. All right. So on the first point, we use these regulatory capital requirements based on the population of the town that the bank's established in as an instrument, where essentially if the population of a town crosses certain thresholds, the capitalization, i.e. the equity that needs to be raised in order to create this bank, either doubles or more than doubles. And this is a binding constraint for many reasons. This was a period of unit banking. There were residency and investment requirements for directors, and $50,000 is just actually a lot of money. So this imposition of these requirements were a big change relative to what was going on across states before this. So the way we construct our sample is we look for towns that are pretty similar beforehand. So as of the 1870 census, they all face the same low capital requirements, and they don't have a national bank as of 1875. So this allows us to focus on the impact of the first national bank, which we think is relevant because this is where, we would expect to see the biggest change coming from an introduction of better monetary services. And then as of the 1880 census, some of these towns will have grown, others will have shrunk. We're going to require that the ending population is between 4,000 and 8,000. So that limits outliers that really had explosive growth for some reason and ones that died off for some other reason. So towns that aren't going to be comparable. And we're going to see which of these actually had a national bank as of the mid 1880s. Right. So this instrument is essentially crossing this 6,000 people threshold, where that will lead them to face exogenous higher entry costs on a per capita basis. As in Mark's work, we're also going to control for unobserved differences that might show up in the growth trajectories of these towns. And so we're going to directly control for population changes between these decades. So the identifying assumption is that essentially there's no concurrent shock to smaller towns in 1880 that would impact these outcomes that we're going to be looking at. All right. So the first stage is pretty strong. We see that, being a slightly smaller town and not crossing that threshold leads to a 30 percentage point increase in the likelihood of getting a national bank, and therefore, getting access to these slightly different bank services. And we do a first stage falsification test at different placebo cutoffs. So you see that it's really happening at the 6,000 mark. Okay, so I've discussed the source of identification. Now I'm going to talk about our indirect channel and why we should think of this as a liability side change to bank services. So prior to this introduction of this uniform currency, the currency or the money supply in the United States was comprised heavily of private banknotes issued by state banks. And these notes were, broadly speaking, very illiquid. They weren't legal tender. They were only redeemable at an originating bank. And this generates a lot of uncertainty about the value of any given note that you're holding because of counterfeiting risk or bank solvency risk, right? So the only way in which this $3 from the Bank of Boston is actually going to be worth anything to buy goods with is if you can, if you have faith that if you took it back to the Bank of Boston, you either got something real for it or that someone else was willing to take that currency. And so contemporaries really emphasized in the historical dialogue just how difficult it was to transact with these different forms of currency across very small local borders. A different way to measure illiquidity is to look at the discount that one would have to take in order to convert a quote foreign note into a local currency note. And so here I'm plotting Gary Gorton's early work showing the banknote discounts from different banks, different states relative to Philadelphia. And the point is that there's a lot of variation both across space and over time. So it's kind of difficult to predict at what point any given note will be worth, 90% of its face value or 10% of its face value. So in contrast, the national banknotes were designed to precisely alleviate concerns that there should be a run on the notes themselves. And they do that by backing them 110% in federal government bonds. And that means that there's zero default risk on these particular liabilities. And they also introduced legislation that required that any national bank was going to redeem the note of any other national bank. So now there's this national network for redemption, which increases the liquidity of any given note. All right. So, the way we think about this introduction of the uniform currency is that we now have a local currency that has much better money-like features, and that they're going to be particularly useful for longer distance transactions. And finally, I'm going to talk about the restrictions on the asset side of the balance sheet for these new types of banks. And basically, this is written in their legislation that they're not allowed to hold real estate under mortgage as some sort of collateral, take that as collateral and to hold it on their balance sheet. And in practice, this meant that there was very little credit flowing to the agricultural sector. So broadly speaking, national banks were generally understood to have focused more on the manufacturing sector and especially through lending through short-term loans. All right. So overall, the way we think about these the impact of having a national bank is that they improve local liquidity, which raises the market access of any given location. And this comes from both the direct supply effect, that there's more currency supplied locally, as well as the compounding network effect, that as other banks around the country are taking these notes, that liquidity compounds. It's very similar to how stable coins right now haven't really taken off, but you imagine they would do so much more if there were these network externalities. Okay, so we think that this would be particularly relevant for non-local transactions where those information frictions and that generate illiquidity for the other types of notes were particularly strong. Okay, so that leads us to a few predictions. The main one is that the traded sector should benefit relative to the non-traded sector. So in the interest of time, I'm just going to show a couple of results and then conclude. We look at output.
Two minutes on time, Chenzi. Thanks.
Oh, okay. Thanks, Kris. So in the agricultural sector, we see that there's actually not too much of a difference in either total production or in total land value when we compare places that we're either slightly smaller or have this instrumented access to a national bank. But what we do see is that the non-traded share of output declines significantly. Okay, and this is to us a pretty strong indication that in the sector that was unlikely to have gotten direct credit on the asset side, you actually still see these real effects coming from compositional changes that are directly tied to this mechanism of trade costs going down. We see this in labor markets as well, where professions that are linked to trade, such as commission merchants or buyers and shippers in the census of population, also increase dramatically relative to other professions. And we can look at a variety of blue collar or white collar professions. In manufacturing, we do see increases of pretty much across the board, but this isn't coming from capital so much as it's coming from being able to source more inputs. So again, consistent with this idea that trade costs on the input side are going down and allowing them to produce more. Okay, so just to quickly wrap up, we see that there are these benefits to the traded sector, and we think that the mechanism ultimately is coming from this introduction of increased liquidity from these different this new source of money in the economy. So thanks a lot for listening, and looking forward to the discussion.
Okay, thank you for that, Chenzi. Looking for Mark Carlson, paging Mark Carlson for comments.
Hello.
Oh, you're there.
I hope I'm here.
10 minutes.
Perfect. And let's see. Can you confirm that you can see my screen?
Yeah.
We can.
Excellent.
Yes.
All right. So thank you very much for inviting me to discuss this paper. This is a really important topic, and I very much value the way that the authors are sort of approaching trying to answer the issues involved in this endeavor. So these are my views. These are not the views of the Board of Governors or anybody else at the Federal Reserve. So Chenzi did a very nice job of describing the paper. I want to explain how I'm viewing it, which is going to hopefully set up my comments. So I view this as this is seeking to understand more about the interaction of financial development and real economic development, and the way they're going to do that is by exploiting this discontinuity in the ease with which a bank could be chartered in towns that results from a quirk in the capital requirements for the national banking era. What they find is that there are impacts on economic development in towns where banks entered relative to towns where banks did not enter. And that's going to allow them to conclude that finance, and banks in particular, did matter for the course of economic development. So I'd like to sort of talk about three different topics in my discussion. So the first topic is these findings on what is the impact on the local economy. And the authors, when in their regressions that Chenzi was getting to at the end, there's a lot of them. They talk about agriculture, manufacturing, different types of employments, patents, etc. And I think there's a lot there, and I think providing a bit more context in terms of the literature would be very helpful. Right? There's a lot of literature on the linkages between finance and growth, both in the United States, but in other countries, in different time periods. Some of this work is on the national banking era that's exploited either this particular same capital quirk or other aspects of the national banking era. To look at, some of the variables are similar, so agriculture output and manufacturing or the like. And I really I wanted a bit more context in terms of how your results sort of compare to the other results for the national banking era, but also to allow us a bit more to think about, how do these results compare to, other periods in time? How do they compare to what's going on in other countries at the same time? Just so we really get a sense of the how the development here looks like or does not look like what's going on elsewhere. And I think that will help when you get to, the novel results that you have, because there's some things that you think that you include that I think are really neat, that I haven't seen elsewhere. I think the shift towards tradable agricultural goods is neat. The idea about different jobs that you're seeing is really fascinating. The increase in patents, and I guess sort of like I was saying earlier, it would be helpful also to know how these things are related to each other. Right? You're kind of getting to that story, but I want you to flesh it out a little bit more about telling me what sort of things that commission merchants do. What sort of areas are these patents in? Are the patents in the sort of goods that are shifting, or where the activities of the town are shifting toward, or is this just a wholly different sort of thing that's going on? And I think this is going to be connected to the second topic, which is, what is the mechanism by which the bank is affecting development? This is a super important topic. This is also really hard. And I give you total credit for taking this on. So the challenge is that banks are doing a lot of things, and you can't always observe this from the balance sheet, right? I mean, you can observe loans, but just the capacity to make loans can be super important. Like, firms are more willing to engage in particular activities because they know that they can go to the bank to fill a liquidity hole if it develops, even if they don't have the loan at the current time, right? So this lending backstop is important. There's the fact that banks provide access to payment services via bank drafts, via correspondent networks, by checks. John James and David Wyman have documented the changes that were going on that were important during this particular period, and the importance of these in economic activity during this particular time period. There's also, as the authors note, there's access to currency and sort of a stable currency. And the paper posits that the currency mechanism is the one that matters. But teasing these out is really hard, and saying maybe they all matter. How much does one matter relative to the other? I just didn't find that the regressions are providing the tight linkage between the mechanism that you point to and the outcome variables that would allow me to distinguish that particular mechanism here. So I have some suggestions about what you might do, right? So one is thinking about where are banks setting up with correspondent networks, or if tradable agricultural goods are important, then potentially having correspondence in Chicago, where there's the exchanges and these goods are these agricultural products are heavily traded, might be really important. Or maybe there's setting up correspondence with regional reserve cities where there's payments processing or shipping ports or the like. And so that might tell you something. There's also, you could look at the occupations of the board of directors. And I think you can also get the initial stockholders from the archives. And so if you know who is willing to pony up the money to start the bank, then that gives you an idea about who is expecting to benefit from the bank and where do they think that the bank is going to be earning the most money. And that might also give you a sense of the mechanism that people are at least expecting that the bank will translate to economic activity. And you could also try to compare it to, what happens if you get a national bank versus a state chartered bank. And there's still the same, you still get the same sort of capital quirks because the state and the national banks are not aligned in terms of the capital rules. But states banks have different, they can't issue the notes. So this might allow you to highlight that mechanism versus states being able to engage in lending directly against real estate, which might allow you to tease out some things as well. All right, and then the third issue I want to talk about is a bit more sort of the technical aspect of some of the approach here. So you're looking at entry of banks from between 1875 and 1885 in towns that have less than 6,000 people as of 1870. Now, for several years, right between 1875 and 1881, these capital requirements are the same across all of these towns. It's really not until 1881 and the census data becomes available that the capital requirements are going to shift. And so towns that cross the 6,000 threshold to get these higher capital barriers are likely to be larger, right? So if you start out with 5,500 people, the idea that you're going to get to 6,000 people, it's a lot. You need to attract a lot fewer people than if you start out with 4,000 people. It's also the case, though, that if you have 5,500 people, you might be just more economic activity. There's more motivation for a bank to set up shop in that town, between 1875 and 1881. And so you're combining these, by looking at this particular decade, you're combining a period where a town of 550 people first starts out with there's a greater reason to found a bank there. And then at 1881, there's a lower probability of starting a bank there relative to a town that started out with 4,000 people. And you can kind of see that. So this is a chart from my paper with Sergio and Stefan. And you see that, I don't know if you're just a little bit below the 6,000 threshold, you're highly likely to get a bank. If you're below if you're way down to 4,000, you're much less likely to get a bank. So I'm a little worried that you're combining some of these things. And so what this really says is it would be very helpful if you lined up how the timing of when these towns have these different capital requirements versus the outcome variables that you're looking at, right? And you're getting to that in some of the robustness sections of the paper that in the robustness discussion in the paper. I just need you to go sort of all the way to fully aligning the capital requirement differences and sort of looking at the likelihood of bank entry and then the outcome variables that you got. So thank you.
Thank you, Mark. Now it's time for a few questions. We have about 3 or 4 minutes. There's one in the room here on site from Chris Haynes. You got to come up here, I think. You can try this microphone down here, but I don't think it's on. Try it first. Do a sound check. I don't think so. Yeah. Mic drop. Come up here.
One of the things that Mark expressed was skepticism about your argument about the mechanism, that it was primarily about the supply of currency. I would like to express complete disbelief in that, because I'm not quite as nice. I think national banknotes circulated everywhere. It wasn't any harder to get national banknotes from a private bank or a state bank than from a national bank. They didn't circulate locally. The whole point of them was that you didn't need to know about the local bank to use them. I think that Mark pointed out that other mechanisms might be short-term credit and long-distance payments through drafts and correspondence networks. I think that if you read about the way that business was carried out at the time, and particularly agriculture, I think you'll quickly conclude that those particular aspects of banking services were what mattered.
Another question from Matt Jaremski coming. Got to come to the podium.
So getting at this mechanism, I think this is where this paper makes the biggest effect. So I'd really kind of push the narrative in that. I think I'm less skeptical than Kris, just because if you think of a new bank comes in, it's creating a lot of currency that gets spent locally and then gets shipped off. So you might have this really big initial effect of currency. One nice thing you do have on the national bank balance sheets is you do have circulation, or you could even think of, and if you didn't want explicit circulation, you could go with like bonds, US bonds being held, those kind of things. So you're not only controlling for bank entry, but then that choice there would be something I was really interesting. I know correspondence, you probably are not going to be able to get that for the period, unfortunately. But one of these things, I just think it's really important to keep pushing that narrative, because that's, I think, where it makes this paper particularly special, different from Mark's or other like just pure finance growth. So that's where I'm going to keep suggesting you go, Jensi. Thanks.
Yeah, we have like maximum 60 seconds for response if you want to take it. If not, we can invite Sasha to come up and give the next paper.
Yeah, I mean, I welcome skepticism. It's a healthy thing to have in the profession. So I think I'm just going to quickly respond to the technical point, which is I'm not sure I really understood that. My understanding is you want us to do the timing of the outcomes to be in 81 or 82 as opposed to a few years later. But I can follow up separately on that because we did a lot with timing and that doesn't, of where when we're measuring the outcomes, and that didn't make any difference. But yeah, with respect to the mechanism, that is indeed the difficulty with this paper.
Okay, thank you, Jensi, once again for a great discussion and paper. We'll have Sasha Indarte next with a paper on bad news bankers. So one moment while she puts her slides up. It doesn't work in Acrobat. You have to do a browser unless you can figure something. Yeah, that's probably the best we can do.
I'm just looking at the best way to get the slides to move.
Which one? Oh yeah.
Okay, I think I'll use page up and page down there.
Yeah.
So yeah, while I'm getting these shared, thank you so much for including the paper in the program, and also big thanks to Kris who jumped in last minute to be able to discuss this paper. The paper explores the role of financial intermediaries, and in particular, their reputation for acting as a monitor of borrowers and how this can contribute to contagion. And I study this in the context of early sovereign bond markets. So a regular feature of financial crises that exhibit contagion are shared financial intermediaries. The typical story we have in mind when we think about how a common intermediary could facilitate contagion centers on their role as a lender. For example, a borrower defaults, this harms the balance sheet of their lender, that lender restricts credit to other borrowers, perhaps triggering further defaults, impacting additional lenders, and so on and so forth, spreading financial distress. An alternative channel that has received less attention in the literature that could also contribute to contagion instead centers on financial intermediaries' roles as monitors of borrowers. Now, to fix ideas, when I talk about monitoring, what I mean are a monitor is an intermediary that's charged with a responsibility like due diligence, advising borrowers, serving as a liaison between borrowers and investors, and perhaps implicitly, there's an expectation that they can exert some influence and persuasion over the borrower to act in the interest of the investors. Some modern examples of monitors include credit rating agencies, underwriters across different financial markets, and also lead lenders and syndicates. Now, importantly, monitoring is something that can be difficult for investors to directly observe and to directly verify. This can create scope for moral hazard where a monitor is tempted to either slack or perhaps exaggerate their ability to be a monitor. And when there's a default, that can set a signal to investors about the skill or willingness of that monitor to engage in those activities. Non-defaulting securities sharing that monitor can therefore be impacted if investors become skeptical about the future performance of those securities if they now think, for example, the due diligence wasn't done so well or that this monitor is less capable of exerting influence. Now, I'm going to explore this in the context of early sovereign bond markets. I'm going to focus pre-1914, and I'm going to study the underwriters of sovereign bonds. Now, these underwriters, they acted as monitors, and in contrast to modern day underwriters, they were involved not just in the origination phase, but also after origination of the securities. Some of their roles included conducting due diligence. They would, the idea would be that if you were a good monitor, you were able to obtain superior information and perhaps have influence over political and industrial leaders in countries. And the underwriters would also play a role in aiding investors in the negotiations during a sovereign default. Now, these types of monitoring activities are difficult for investors to verify and observe directly, and they can also, we can think of them as costly actions. Now, what this means is when default occurs, that sends a signal not only about the sovereign, but also about their monitor. the investors learn about the ability to monitor and undertake these actions from default. Now, rarely holding sovereign bonds, these underwriters, they primarily acted as intermediaries, bringing the bonds to the market, and they would rarely hold them long-term on their balance sheet. So the question in this paper that I explore is if sharing a defaulter's underwriter can reduce the price of non-defaulters' bonds. That is, can we see a quantitatively significant contagion from defaulters to non-defaulters that as a result of damage to a monitor's reputation? So just to situate the paper in the literature, and I'll refer you to the paper for a more detailed literature review, it contributes on a couple fronts. So there's a corporate finance literature on monitor reputation. There's also a historical and more modern focused literature on financial intermediaries and contagion. One of the big novelties of this paper is positing monitor reputation as a source of contagion. This paper also builds on a rich early literature on early international sovereign debt markets, to which a number of folks in this room have also contributed, and also on the call. And a couple exciting things in this paper are some new data that I hope to share publicly soon, and additional data that will also be forthcoming in related to work that Chenzi Xu and I have in the context of other projects. Now, for this paper, I built bond level default data, and ultimately, relative to the broader literature, this paper also contributes new evidence on the importance and impact of these underwriters. So now I want to talk a bit about the economics of monitor reputation. So the relationship between underwriters and investors was characterized by two important informational asymmetries. There was moral hazard, because there are these costly but hidden actions. And there's also an adverse selection problem. So on the part of the investors, they don't know for sure how able or willing the underwriter is to undertake these costly actions that can support the performance of the bonds. So when default happens, that sends a negative signal. What that means is that default damages the reputation of the underwriter as a monitor, and contagion can then spread to bonds sharing the defaulter's underwriter. Now, I'm not going to show this today since we only have 15 minutes, but in the paper, I present a dynamic game that formalizes this reputation formation. And here, investors imperfectly learn from defaults about whether or not the underwriter is monitoring or how good they are at monitoring. Now, I next want to talk about the data that I use in this paper. So in order to implement this analysis, it required a good bit of digitization and some manual labor on my part and the part of a couple RAs as well. The first data source I used comes from the Council of the Corporation of Foreign Bondholders. This was a group of wealthy investors in London that formed to collectively bargain with sovereigns during default. And every year, starting in the early 1870s, they would produce an annual report, which is essentially a list of their grievances with the various countries that had been defaulting. It also had a retrospective feature looking backwards and talking about past defaults and past grievances. But it also talks about the good stuff as well, when countries do repay, do keep their word, and when political transitions, for example, are not as destructive to the ability of the country to repay their debt. Now, from these records, what I can glean are over 200 different defaults between 1869 and 1914. A lot of these are new relative to existing data sets. For example, the Reinhardt and Rogoff default data set. One big difference is I'm including anything that is a negative NPV deviation from the original contract. And the reason for that is that these other, for example, a conversion in which you lower the coupon rate from 4% down to 2%, that's going to have a similar economic effect on the cash flows as just skipping those coupon payments in the future, even without the advanced warning. So it's useful for a lot of economic questions to include those defaults as well. I'm going to be able to identify the month of default for about just over 100 of my events. The reports also have information on the underwriter identity. And from this, I assemble a new bond level data set on default. Now, selective default is not uncommon in this era, so knowing which bonds were involved in the default is especially useful for seeing, for example, which underwriters were the ones actually having these defaults associated with them. So just to get a sense of what this original data source looked like and a bit of why it was a little painful to digitize, it comes in this text format where, for example, we're seeing for Guatemala in this case that Thompson and Bernard, the underwriters, they issued a loan with this principal, this issue price, and so on with the various bond characteristics. And unfortunately, these loans go into default a couple of years later. Now, the second data source that I use, this was luckily digitized by Will Getzman and Geert Roenhorst at Yale School of Management. This is the Investor's Monthly Manual, and it provides beginning and end of month bond prices for about 1,000 bonds throughout 1869. And the full data set goes beyond 1914 up to about 1930. And it covers 75 different countries. Every continent except Antarctica is going to be represented in there. Now, I go and hand match these CFE bonds to the IMM bonds. So one of the public data sets that I'm in the works of sharing is going to be this linkage between the CFB information and the rich information on default, and also this monthly price data. Now, for the purposes of this paper, I combine these into a bond event panel with price information. Now, for the empirical strategy, the goal is to estimate the causal effect on non-defaulting bonds prices of sharing a defaulter's bank. And there's several distinct identification challenges here. So first, in general, whenever we're trying to estimate one particular channel of contagion, you have to worry about unobserved common borrower shocks. In my context, we want to think about country-level shocks that I can't hope to control for. Now, another different concern is unobserved bond-level characteristics correlated with bank exposure. An example of this would be if Barings tended to underwrite bonds that were secured on customs duties, whereas Rothschilds tended to have their bonds secured by revenues on railroads. And then finally, another identification concern is the mechanism. So even if I can show that there's this causal effect of sharing the underwriter, there's also a question of, is this really about reputation capital or financial capital of the bank? Now, to get around the first concern, what I'm going to do is exploit within country variation in bank exposure among non-defaulting bonds. So I'm going to be able to compare bonds in the same country and time with different bank exposures. This is a variant of a Quadrat-Meehan style identification. So I'm going to be able to difference out those country time varying factors that could affect, that could lead to bond price co-movement. Now, for the bank and bond characteristics, partly I'm going to be able to get this with some bank fixed effects. But what about time varying bank characteristics? Well, I can't include that kind of fixed effects in there because it'd be collinear with whether or not you share a bank. So what I do is I look at an array of bond characteristics and do various forms of balance tests. And overall, I see that bond characteristics are not well predicted by tending to share a defaulter's bank, and there isn't similarity between the connected bonds in terms of their characteristics. And finally, for the mechanism, I'm going to test predictions of competing models and mechanisms. And what it looks like is it's stacking up in favor of reputation. Now, the model I estimate is going to look like this. The outcome variable is the change of a non-defaulting bonds price during the default. On the right-hand side, I have three variables, the third being an interaction of the first two. I have the change in the defaulter's bond price. I have an indicator for whether or not you're sharing the defaulter's bank. And then finally, that interaction, which is going to tell me how much more you co-move with the defaulter's price when you share their bank. This table shows the main empirical results going all the way over to column 5, which is added in the country year fixed effect and the bank fixed effect. What these point estimates mean, and I've demeaned these. So for example, the bank, the 1.63, what that means is that in the average default, in which the defaulting bond falls in price about 5 percentage points, non-defaulters that share their bank fall 1.6 percentage points as well. Now, this corresponds to about 30% pass-through of the defaulting bond's price decrease. Whereas if we look at the coefficient for the uninteracted one for the non-defaulting bond, there's about 5% pass-through. So you're going to co-move 6 times more if you share the defaulter's bank than if you do not share the defaulter's bank. So this is evidence of quantitatively significant contagion. Now, what about alternative explanations? So one of the most natural alternative stories is going to center on either the bank's wealth or the wealth of the investors. For example, maybe someone just really likes Barings bonds and other people, they segment and they really like Rothschilds bonds. But luckily, there's a couple testable predictions of this story. So for example, in a wealth effect story, sharing a bank in a larger, where the wealth loss is larger, that should lead to more contagion overall because more wealth was destroyed. Now, with reputation, something I show in the model is when you have a more severe crisis, investors can view that as one that's harder to prevent. So they're going to update less negatively on the ability of the bank to monitor and exert influence. So think about if it's a catastrophe, it wasn't really the monitor's fault. It was perhaps inevitable that the default was going to happen. So you can actually get milder price decreases in this reputation story. To test this, I proxy for the scale of the default with the percent of the bank's bonds in terms of principal involved in the default. And what I find is that Contagion is in fact milder in these larger defaults, consistent with reputation. Now, another fact that I think is useful for thinking about wealth versus reputation capital is the persistence. So here I'm doing local projection style estimates, and we're looking about 2 years after the default. And what we see is that over time, there's a decrease until about a year out where the price is still falling after this default. And then it kind of flattens out and stays at a low level. Now, if this was a story about some temporary selling pressure, we would expect a recovery in between. So this is something I think better lines up with a persistent change to information and beliefs about this underwriter. Now, finally, I mentioned there's also selective defaults. This is also useful for thinking about reputation too. So selective default, and I formalize this in the model, it can send a worse signal for the defaulter because it says that someone else was able to escape default, but your bond in particular was the one that this country chose to default on. So contagion can be more severe, and that's exactly what I see when I look at this in the data. Additionally, there can be a positive signal if you're a good bank that avoided the default when another bond for that country went into default. And I do see that that lines up in the data. The last two results that I'll mention, I see that contagion is smaller for banks that have a better reputation in the sense that they have fewer recent defaults in their history. And then lastly, does sharing a defaulter's bank actually predict higher future risk of default? Are investors just crazy, or are they rationally anticipating that there's greater default risk? It looks like, yes, that is the case. So there's a 4% higher risk of default in the next 10 years if you share the defaulter's bank. Now, just to wrap up, here I document in the context of early sovereign bond markets in this environment plagued by informational asymmetries, monitor reputation can act as a powerful channel of contagion. I find that the average pass-through in default is 30% versus 5% when you share the defaulter's underwriter. And we might, I think it's always interesting to study history, and sometimes it's maybe unfair to ask about external validity in the context of history. But I think that similar mechanisms could arise in a lot of modern settings as well. For example, credit rating agencies and these other examples listed here. So with that, I'll stop here, and I'm looking forward to Kris's discussion.
This first. Sure. While Kris is getting it set up, I'll just say it was a pleasure to read this paper. I only sometimes things drop into your lap, and this happened to me last week as I came in late on this. But it was really a joy to read, and I think Sasha did an excellent job summarizing the paper. So let me get my slides up. To Zoom. Do a new share.
So I was going to make a joke. We were supposed to have Christoph Trebisch, but he couldn't make it, so we found another Kris. So yet another Kris. Thank you, Kris, for stepping in. Are we ready?
Okay. All right. So I was surprised Sasha didn't put this up. I thought that's where the title came from, but maybe it's a bit before her time. Anyway, so this is a great paper. I really enjoyed learning about things in a new and fresh way that I've studied for quite some time. And so let me just kind of characterize it in the broader literature. I think this is a nice paper because there's this issue about wake-up calls. And this was very topical in the 1990s and 2000s. Why is it that we see spillovers in asset prices from one market to another? And that's even in the absence of controlling for direct economic effects like trade or political linkages like wars. And so this is, if you were framing this in the bigger picture, this is what this is about. And it's focusing on sovereign bonds as the asset that we care about. And the hypothesis that is being tested is, we want to understand whether the identity of an issuing investment bank contains information about sovereign borrowers, and that can serve to propagate risk. And so we would see that in the price movements in other sovereign bonds of those underwriters. And so what Sasha nicely does is she builds a game theoretic model where investors care about the actions of the issuers and of the sovereign bonds, and the merchant banks and the joint stock banks, which are what I'm going to be calling banks, but you can think of them as investment banks. They build reputation through who they lend to and how they lend, and then they carry out these actions of monitoring and discipline to kind of build that reputation. And as she talked about, she collects new data on from the Corporation of Foreign Bondholders and matches it up with the well-known IMM data. And then codes up these default events, has about 100 of these events. And the key strategy, which is really nifty here, is that she's comparing the bonds within each non-defaulting country. So you've got a default event, but that's not the country of interest. It's every other country in the sample where the underwriter has bonds. And then there are other underwriters in those countries who don't have the defaulting bonds. And the comparison is, are we going to see a differential price movement between the bonds issued by the defaulters underwriter versus other underwriters? I want to go through fast on this slide, but essentially she finds results consistent with what I would call, this is an informational channel view of Contagion. There are other channels out there we could think of, but you have to pick a thing to study, and this is a worthwhile thing to study. So as I said, this is a really interesting paper, and I think it builds on a literature that seeks to understand the role of underwriters' reputation in a world of imperfect information. So Mark Flandreau and his co-authors have written a lot about this. James Riley has a book on the 18th century Amsterdam market. And this is extending that historical literature, as well as telling us to think more carefully about the sources of contagion independent of history. And so I think it's really nice. It makes a nice contribution to both those literatures. My comments are going to focus on where the model meets history, and then some empirical considerations. And I hope, the idea is, like, if I were thinking about, what are the things I would want to test more robustly in this model, know more about, that was kind of my approach to thinking about these comments. So another movie we have here, this is one she could have used. The idea in the model is that there's a game between investors and banks have the ability to monitor sovereigns and take costly actions to reduce the probability of default. Investors prefer banks to exert effort, but they can't really determine that type of bank ex ante. And so this is like a noisy signal model where investors, trying to figure it out, and then they can't really see if the bank was either unsuccessful at fighting a default when the default happens, or that they didn't even try to exert effort. And so either way, you get this effect on reputation when a default occurs in the model. And so what I wanted to think about is, how do we put that in the context of the period being studied? So the first thing is, the model, as Sasha indicated, it's really a game. And you might, she knows probably more about this than I do, but if you were casting it more broadly, you would want to maybe know, like, okay, is this a representative agent model, right? Because the discussion comes down to things like preferences of investors, right? And if it's a homogeneous agent model, we don't even have secondary markets to talk about. So that wasn't really clear to me. Risk preferences are another area where I think risk neutral investors want higher returns, mean returns, and lower volatility, and yet the revelation of default leads exactly to what they don't want, which is more price variance. And so that's kind of interesting, but I don't really know what to do with that. And then finally, banks privately observe the state of the sovereign's economy. That's an assumption in the model, but there's pretty good evidence that investors were actually quite sophisticated by this time, and they gathered lots of information on their own, pricing bonds to reflect fundamentals. And here you have someone like Nathaniel Rothschild commenting on the hypothetical Kana-Kiva loan and saying, this is a notorious loan, and said, well, anyone who would have subscribed to this loan must have known he is subscribing to a loan which is utterly worthless. Thinking like, here's an investment banker thinking that investors must be smart and know what's going on. So that's kind of those are some interesting assumptions. Now, the way the model is framed is it's really a dance, if you will, between investors and banks. And in this framework, governments are passive. The other aspect that Sasha emphasizes that banks spend resources to fight defaults in ways that creditors cannot. So I want to dig into each of those a little bit. So this issue of whether sovereigns are passive is, of course, a question of practice. And for the 1870 to 1913 period, bankers could choose their banks and they could choose their market. And if the terms of issuance weren't acceptable, they could go to a banker or go to a different market. And so how did they do this? Well, they often did it through sealed bid auctions, or they did it through an open bidding system where tenders were communicated to the government and counteroffers were made. And so that led me to ask the question, how should we think about the selection into a bank? How does that work? Sovereigns, like banks, were also strategic, and they have reasons to claim that they're a good type. Like, look, I do everything I can, and sometimes some shocks come along and I can't do anything about them, as opposed to being a bad type, which is like, actually, it's endogenous whether I want to pay, and I'm not sure I want to pay, so I'm not going to pay. And so that decision to default is, in a sense, a choice theory of the government, and this kind of modeling assumes away from that. So that's one thing I think that maybe would be worth exploring a little further. Another one that I think I'd like to see a little more discussion on is there really evidence that IPOs took action to reduce default risk after the bonds were issued? And the reason I ask this is that much of the literature so far has really said it's all kind of like ex ante stuff that they're doing, and that they're serving as a gatekeeper. What we do know about what they do afterwards is that occasionally they would provide emergency loans. So if you were part of their portfolio, if you will, and you can think of Brazil in 1898, the Rothschilds would provide emergency lending to keep you afloat. I'm not sure that's what Sasha has in mind. And if it's the case, then maybe we could actually code those cases up, and that would be useful and another great addition to the literature, because it would link to what other research has done. But at the same time, we see other banks like Barings that try to brandish or burnish their reputation after defaults, and they do that by acting as collections agencies. And that suggests that defaults may have actually been used to raise the reputation rather than to have it hurt one's reputation, which is what the model suggests. So did investors have ways of affecting the likelihood of a crisis, or was it only the issuing bank? Well, that's a complicated issue and one I want to come back to. But, we might want to think about why banks, regardless of reputation, lack an incentive to take action once that debt was issued. And I think this is what authors like Eichengreen and Portis point out, that banks often face conflicts of interest between bondholders and borrowers. So fees are made by issuing new debt and funding governments, and bondholders want that's honored. So then you get these quotes like in The Economist, where they're basically saying, yeah, this is a big problem. Once the debt is issued, we want to basically issue fresh loans as soon as possible. So it gets to be such a problem that the British government forms this select committee on foreign loans to investigate these kinds of conflicts of interest. So what do they do instead? How do creditors empower themselves? Through majority action clauses, through the corporation of bondholders, foreign bondholders like creditor clubs, and then they pressure governments to intervene on their behalf. And these are all ways we might want to think about these, whether the extent to which these coordination between creditors committees mattered, whether placing countries under fiscal house arrest mattered, whether there were boom cycles in lending characterized by riskier lending activity. And so these are all opportunities where one could kind of add additional variables to the regressions to make sure the results aren't driven by omitted variables. As Sasha mentioned, there are debt conversions. And these are special cases because a new underwriter and old underwriter can be used to consolidate existing debt. And I think it's worth thinking about how we should think about these cases given kind of their serial dependence. It got flipped somehow, but it's from Flores's recent paper. But what it shows is that very few of the original houses that issue debt in Latin American defaults participate in the conversions. And so that's kind of curious. And I think we need to think about that, because then we have this other issue of this time period and of present, which is there are serial defaulters. And so there's going to be some dependency that we need to think about here with these kinds of issues. Last slide, Kris. Finally, British colonial bonds. It turns out they're a very large share of the relevant sample. So you have Canadian, South African, Australian, New Zealand bonds. They're all key for identification. If you look at these bonds in these other countries, they're all trading in the top 10 for during the default periods. And that's a little concerning because these bonds have an implicit colonial guarantee, which has been shown in the literature. Moreover, what's really important for this paper is that the banks that issue these specialize only in lending to Dominion or Crown colonies. So in green there are the number of non-defaulting bonds, and these are a huge part of the sample. And so this concerns me that the results are being driven by essentially all these banks in the data set have no chance of ever defaulting because there's an imperial guarantee behind it. And if they're also a big part of the sample that's being used for identification of the comparison, then it seems like we're blowing up the results. So my suggestion there would be to focus on sovereigns, because I think there's a segmented market. Again, this is a super interesting paper. Thank you for giving me the opportunity to discuss it, and I look forward to sharing in the future versions with Sasha. Thanks.
Okay, we're running up against the time constraint, so we'll allow one or two questions from the audience or from Zoom. It looks like there might be some questions in the chat. No. Looks like your slide was the right way for the Zoom people. Any questions? We're gonna make a 1-2 minute response, Sasha.
Sure. Thank you so much, Kris. That was extremely, extremely helpful. I'm really happy to get your perspective on this paper, and I think there's a lot of really good suggestions in there. I think one thing the one thing I'll choose to talk about right now is this evidence of, what actions, if any, were they taking after the defaults. So a couple of things about that. So as you mentioned, these emergency loans, one observation I'll make is that there's an isomorphism to what I have in the model. You could think that like this costly action that they're undertaking is the cost of extending this kind of liquidity. So their reputation and ability to engage in this kind of like short-term lending could also be part of the role that the monitor was taking on. And then also, you mentioned a Rui's paper as well that looks at the haircuts and the recovery rates. And the CFB, they generally did better, perhaps because their interests were better aligned than perhaps the banks who are trying to keep both the sovereign and the investors happy. The banks tended to do worse in terms of getting haircuts, favorable haircuts for the borrowers. And there could also be heterogeneity in those underwriters. That could also, their reputation for getting a good default outcome could be part of what's going on in the background here. And then I'll also add one result I didn't have time to add, or else I probably wouldn't have had time to mention, is related to the due diligence part. So something, it's not in the paper yet, but I've run recently, is that when the bonds are closer in terms of the age, in terms of being issued within a year or two of each other, the contagion effects are stronger, which I think is consistent with, they were doing bad due diligence at that point in time. So to me, that suggests that due diligence is part of the channel, and it's harder to think about why age would matter for wealth or these other stories as well. I'll stop right here, but again, thank you all so much for attending in person and remotely, and big thanks to Kris for the comments.